अपना Hello, guys. Good evening for you. Good morning for me.
Good afternoon.
Hello.
Good morning.
Good afternoon.
So let's just wait maybe 2 or 3 more minutes for more students to join in, and then we can start.
Hello, Joao. Wish you a happy new year.
Happy New Year, man.
So, Joao, while the others are joining, so we are 1 week away from submission of the assignment.
I know.
And
The intense
so
assignment. I know.
yes. So I think more or less as far as the calculations are concerned, we seem to have figured out most of the things. A few things still we have sought a clarification from the university, uh, and maybe today after you cover the budgeting, right? I guess that's the scope, right? After
Yeah.
that, maybe we can just walk through the report, because we're just trying to understand when we have to do the financial planning and we have to give recommendations.
Yes.
Generally
Yeah,
what yes, what
absolutely.
can we
I
put
also
into the
have
report?
a specific presentation for financial planning and financial analysis, because one of the students asked me the same thing and said, "Hey, we need like a clear guidance for everything." So I prepared a guidance. I will
Oh, that's
present you
great.
the guidance, so no worries.
Super. That's great.
Yeah, and I will also send you the guidance. I will ask for your emails from upGrad or from university, and then I will send you everything, like all the presentations, all the materials, so you guys can follow at home. When after class, you can just reread, go through it, and then you can do the report more easily.
Joe, that is great. Otherwise, what you could do is, if you could put everything onto maybe a Google Drive and drop us a link over here, because there's always a slight lag, because by the time you give to upgrad, it'll take 2-3 days for us to get it. But because we've got a weekend right now, we've got a Sunday tomorrow. So maybe if you can share a Google Drive link, you could put the data into the Google Drive
Okay.
link. That would really help.
Okay. I will do the
Yeah,
best.
Joe, that would be a plus one for Aditya said, because it takes long time to get the details when it comes to upgrad. This would be quicker and easier for us.
Okay. So I think we are more or less everyone here. So I will start with the budgeting. I also have some cool examples to show you, and some templates to show you guys that you can also use in your own companies if you need, or if you need to do budgets for yourself. So I also will show you guys how to do it, and I think it will be super cool for you guys to have this information. Okay, so I'll share my screen now, and okay, we are here. So good morning, everyone. We are here for the budgeting class. Of course, after that, we can look at everything, all the doubts that you have. I also will do a financial analysis presentation for you to understand like what is expected also from the report, and it will be great for us to do everything together and to look at everything in one big file and on one go. So yeah, so let's start. So about can you please mute your microphone? Okay, thank you. So regards to budgeting, so we have in a nutshell 3 types of budgeting. So you will learn 3 types of approaches to budgeting, which are incremental budgeting, which is the most normal budgeting that we see in companies nowadays, especially big companies. Value-based budgeting, we normally see this in technology or pharmaceutical companies that are looking to increase a specific type of department inside the company. And zero-based budgeting, this normally happens in startups and in companies that are really looking to save money on specific departments. So first, there are 2 approaches to budgeting, which are the extreme ends of the spectrum, which is imposed budgeting and participating budgeting. This is inside each type of budget. You can have these both. So imposed budgeting normally comes from the management side. So it's a top-down process. Top-down means from management to the employees down. So management takes the goals of the organization and assigns budgets to each division of the organization, meaning that management and managers do all the decisions. It gives all the management the complete control and allows them to align directly with the goals that they themselves have for the company, so the shareholders. It's also the quickest budgeting approach because it relies less on the organization and more on the management, the shareholders, and the chairman side. Participative budgeting is a bottom-down approach, meaning that each department is going to provide recommendation to their clients, and they are going to really say and show like what they need in each department, each division, that can then be passed through the managerial side, and then they can do the budgetings after they know the real challenges. So challenge with the participative budgeting is that the cost can get out of control. It can be a lengthier project, meaning that if every department takes a long time to do their recommendations, it will take a longer time than for management to do the final type of budgeting. But it's the most inclusive one. Then you have a middle spectrum, which is the negotiated budgeting, and this is more like a shared responsibility. This normally happens is more smaller or medium enterprises where the management sits down with all the departments and comes to a joint decision. And this normally happens, for example, with startups or smaller companies where both negotiate what is best. And this not always happens because when we have very big companies, there is not enough time, or this type of approaches between departments versus management sometimes doesn't happen. But this is how it should be, all negotiation and the shared responsibility for the budgeting. So looking at the methods, let's look at the incremental method, then the value-based, then the zero-based. So all these imposed budgeting or participative can happen in all these three types. So, and these three types is how the company is going to look at the budgeting after being decided what to do. So incremental budgeting. So this one is normally considered the quickest, simplest, and the most common one, is what we normally see in, again, big companies and companies all around. So it's simple, quick. However, it provides at least financial value to the company, and it's a top-down approach normally, and it requires almost no input from the organizational staff. So you take the budget normally from last year, and then you do incremental to the last year, and you account for example, the inflation or some other growth method, and that's how you normally do. So it's generally used by companies to spend less time on it or on the budget, and also it's a spend it or lose it mentality, meaning that you put the budget into the department, and then the department either spends it or lose it, and it's already budgeted in the accounts of the company. So some advantages: it's quick, stable, easy to implement. Department managers can have the stability of the cost allocation, and disadvantages is that it assumes that the business will continue without any problems. It has normally no incentives or reduced costs. It's just an increment. It encourages also sometimes departments to spend a little bit more, and it may or may not consider some economic circumstances sometimes. So we have here an example. So this is what normally companies do. So you have your budget, for example, for the wages of the staff, your rent, your utilities, administrative costs, etc., etc. And then you have the budget for 2021, meaning that, for example, you have 2.4 million. For rent, you have 850K, utilities 500K. And then in 2022, what you do is you just multiply it by a factor, in this case, 3%, and you just do the increasing, meaning that you just factor for a small increase on the inflation or on from the small growth that you calculate with your company, like, okay, we are going to grow 3% a year. So you calculate that, and then you calculate your expense based on that. This is what the majority of companies do nowadays, and it's the easiest method. So looking at the second approach to budgeting, so we have value-based budgeting, or these types of budgeting, more bottom-up approach can be used. Here, the companies normally focus themselves on a department or something that they want to really value within the company, and by that they then apply a little bit more money to this department to see growth in this department, and to see more positive results. For example, this happens a lot in tech companies or in pharma companies, and you can see here that the Facebook, throughout the years, what they are doing is the research and development. They are increasing this one versus the other one that you see decreases or stagnation. Then in the research and development, you see they are increasing constantly this budget for this department. And you can see that nowadays with Meta, so Facebook is launching Meta and Metaverse and all that, and because of that, they are really focusing on putting more and more money on this department. So they are really focusing on making Facebook now the Metaverse company. So they are putting even more money on this side of the company. So, and then the last type of budgeting, so zero-based budgeting. So for the zero-based budgeting, this is the most comprehensive one, the most, we'll say the most grounded approach from all these budgets. It is a bottom-up approach, meaning that you normally ask the people what they need, all the department what they need, and then you can build it up from there to the managerial part. So with this approach, each department starts from zero and must build a case for every expense, meaning that you don't waste money and you don't budget based on last year. You normally start from scratch, and then you will do something each year that you need, and that how can each department really uses and allocates the best budget. So finding normally the zero-based budget is the best approach for budgeting, because you start from scratch every year and you see what you really need and what you really want to achieve. The major benefit is that forces the company in a culture of cost management. So an example, so zero-based budgeting is normally suited for companies such as startups, because they are allowed to change. They normally change business plans, like they need a lot of flexibility throughout the years. So, and you see this a lot with startups. So start from zero and see what you really need for each department and expense of the company. So this way you can have the best results possible. So now let's look at some examples in Excel. Please mute. Okay, thank you. Okay, so I did this example to show you guys, and I will also share this one with you for you to use in your own company, in your own startup. You can start a startup, and it's just a way to show you how can you budget in and what you need for you to budget in. For example, this one, you started from the year basis, and then you divide the expenses by month. And what do we have here in consideration? So the team, small team, is a startup team. So CEO, COO, employee 1, 2, 3. For the first one, we have So we have health insurance for all of them. We have some housing benefits for some. Then we have this the expenses spread out throughout the 12 months. So this budgeting specifically is for a consultancy company. So for these, we account for travels, events, hotels. We account for office and IT budgeting, meaning that you always need an office for office supplies, cell phones, computers. And here, for example, why this one is only accounted once, the cell phone, the computer, because this accounts for buying new equipment, and you don't need to spread out throughout the year, just buying once once in the year and it's done. So we account for extras such as lawyers and outsourcing extra if necessary. And then we have extra services like office or a secretariat, auditor when needed, and postage, and the contingency, extra contingency, making a total budget for this company as an example of about 700K a year. So as you can see, the medium to small to medium company, but is a great way for you to see how to really budgeting something that it's simple but it's very efficient in everything that you need. Another example, this one is so this one is an example of a zero-based budgeting. So you start from scratch and you just build up in, you just see what you need for this year specifically. So zero budgeting.
Sorry
this
to
one,
cut in. Can you please
Sorry,
mute
Joe.
everybody?
Yeah, please. Arpita, can you please mute? Sorry, Joe, to cut you, but there is somebody who is snoring. So we are not able to hear you clearly.
oh, okay.
Can you mute everybody, Joe, once?
Yes.
Yeah,
Absolutely.
please mute everybody, please. Yeah.
Okay. Okay, I think everyone is muted now. Okay, now it's good, right? Okay. Okay, fantastic. Thank you, guys. Okay, I see that there was some craziness in the background. Okay, no worries. Okay. Okay. Oh my God. Okay, so let's go back to class. Yes, I will reshare screen, no worry. Okay, so maybe I will repeat this last part for the ones that couldn't be able to hear. So this is an example of a zero-based budgeting. So you start from scratch and you build your year from scratch, and you really see what you need from your company to really thrive for the next year, meaning that you budgeting in the year and then you can spread out throughout the year your expenses. So this is a great way, and I will share this with you, so don't worry, you can use it as an example for your company or for any project that you are building. So this is a great way to start. Zero-based budgetings are great for startups, so this is a great way to start. So looking at the other example, this one is an incremental budgeting type. So here it's a little bit more simple, a little bit more clear. For example, here in the management salaries, we don't have like who is the manager, who is the employee 1 or 2. The other salaries, we don't have like the breakdown. So we have a more simple and a more summarized way to put it, but it's still a great, very clean way. For example, if you are going to do a presentation for your manager, for your CEO, you should take something like this because it's so clean and clear, and it's in one one go, you can see everything. So you have here, for example, the management salaries, the other salaries, other people and benefits, and then you have the personnel expenses, and then you have an increment year by year. If you see, you have an increment of 10% year by year. So, and this is what incremental budgeting is. So you just you have your budget for now, or what happens in the present, and then you just increase it throughout the years and do your forecasting for your budget. Office materials, legal, market research, market expenses, traveling, software, banking fees. It's interesting that that this example, this specific company decided to put an extra for like banking fees and transactions. So it's a company that probably will make a lot of transactions. Rent office. Another very interesting one that I want to point out is donation to charity. So they decided to include it in the budget, a small percentage of money every year for donations to charity. And then, of course, contingency. Never forget about contingency. This is very, very important because you never know what can happen. So having an extra for contingency is something that always very, very good. Then you do your calculations and you have your final budgeting for the year with your increments. So pretty simple. And again, I will share this one with you so you can have this for your companies and for your own personal projects and everything. So I think it's a great example. And just to tell you, for example, if you wanted to do a value-based budgeting, what you need to do is simply like increase something that you need. For example, if you are doing something that requires a lot of legal, a lot of lawyers, because you are maybe want to pass a new patent on your company, you need a lot of legal activity, then you increment this one and you are doing value-based. If you need a lot of traveling because you are maybe testing a new product in a new location, you increase your travel expenses, you are doing the value-based budgeting. So you are increasing the department that needs the most and then probably decreasing the other ones. Maybe you don't need so much software, you can decrease it. Maybe you office material, decrease it. You know, maybe even this is not a year to donate to charity because you are focused on your R&D, decrease it. And then you do value-based. So yeah, so that's it. So continuing on the presentations, I also did a financial analysis presentation that I want to share with you, more specifically for the paper that you have. So I did this one because some students also asked me like, if I can give a general debrief of what is expected in the paper, what you should do, and especially for the strategy, because one thing that the university is telling me all the time is focus on the strategy and on the managerial side, because this is an MBA, this is not a master's in finance, this is not a master's in mathematics. So what they really want to see is how well you do in strategy and how do you think strategically and make good strategic decisions and managerial decisions. So I put up this one, and I will also share with you. But let's start. I think this will be very helpful for you guys. So in terms of financial analysis, so you have 6 steps developing an effective analysis of your financial statements. So identify the industry and the economic the industry economic characteristics, identify company strategies, assess the qualities of the firm's financial statements, analyze the current profitability and risk, prepare forecasted financial statements, and value the firm. So for any financial professional, it's important to know how to effectively analyze the financial statements of the firm, and this requires an understanding of the 3 key areas. So the structure of the financial statements, the economic characteristics of the industry in which the firm operates, and the strategies of the firm that the firm pursues to differentiate itself from the competitors. So we can see here that there are three clear areas. So financial statements, which we already know very well from our paper, the economic characteristics of the industry. So we know that we are in the restaurant business, and the company is working in the US, now expanding to India. So we need to have in account all these two geographies. And then the competitors. So who are the competitors? This is something that you always need. So one thing that we do in financial analysis and when looking at a firm is always looking at both sides of the spectrum to have in consideration the competition. That's very, very important, because you are always comparing something with another thing. So you are comparing this company to another company, the competitor, and say we are better because, or we are worse because. So this is the base for everything. So let's start by the first point. So first, to determine a value chain analysis of industry, the chain of activities involved in the creation, manufacturing, distribution of the firm's production or services. Techniques such as Porter 5 forces or analysis of economic attributes are typically used in this step. So I will give you a very powerful and simple tool that you can use to measure these types of characteristics, which is the Porter 5 forces analysis. So Porter 5 forces analysis is this that you can see here in my lab. You have a competitive rivalry, supplier power, buyer power, threat of substitution, and threat of a new entry. So let's start with the first one. So competitive rivalry. So these forces examines how intense the competition in the marketplace is. Consider the number of existing competitors and what each one can do. So rivalry competition is high when there are just a few businesses selling a product or a service, when the industry is growing, and when consumers can easily switch to a competitor's offer for a little cost. When rivalry competition is high, advertising and price wars will surge, which can hurt the business bottom line. Meaning that here, what you can see and what you can analyze is like how big the competition is in comparison to the company that we are evaluating. So do they have a lot of competitors? Who are they? Are they selling more? Are they selling less than we do? And what type of competition are there that can steal our customers? So second one is the bargain power of suppliers. So this force analyzes how much power a business supplier has and how much control it has over potential to raise its prices, which in turn lowers the business profitability. It also assesses the number of suppliers of raw materials and other resources that are available. The fewer the suppliers, the more power they have. Business in better position where there are multiple suppliers. You need to learn more about suppliers from the B2B partners, meaning that, so we know that we are dealing with food for our case study. So our raw material is in sense food. We also have the gifts and all that, but still our raw material is mainly about food. So we need to know which suppliers are there to supply food for our business. For example, since it is a food business, probably there are a million suppliers, so there is not a scarcity of suppliers for our business specifically, but this is an example that you can do for many other businesses. So for example, if you are looking at a business that deals with wood tables, and you need to have a supplier that needs to cut down trees and do all this manufacturing of trees, from a tree to a wood, tree to a piece of wood, from a wood to a table, then you can have some people from your supplier side raising prices or creating price war. So the bargaining power of suppliers is something that we need to take into account for our business. And let's go to the next one. So this one is even more important, the bargaining power of customers. So how much a customer is he wants to pay for our product, meaning that so how the pricing and quality can affect the customer. So customers have power when they are fewer in number, but there are plentiful sellers, and it's easier for customers to switch. We don't want that. We want customers to stay. Conversely, buying power is low when a customer purchases products in small amounts, and then the seller's product is very different from its competitors. So we need to really know and to understand our customer. So is our customer okay with our pricing? Is our customer not okay with our pricing? Should we increase it? Should we put it lower? What type of buying power do our customers have? So knowing our customers in a nutshell, very important for this analysis. Then the threat of new entrants. So this force considers how easy or difficult for competitors is to join the marketplace. So since we are in the food business in our example, it's probably quite easy for competitors to jump in, because in restaurants business, competitors come and go all the time. But we see that, for example, we also offer the gifts thing, not only the meal kits, the meal kits, the gifts, and the other third product. And so we have quite a big spectrum of products. So we probably can differentiate ourselves from the competition. But so we need to see like how easy or not is for another company to start selling exactly the same products that we sell. I don't, since this example, our company is a bit outside of the norm with the gifts and all that. So maybe it's not so easy for a restaurant to also offer gifts and something, but it's something that we also always need to see which, like, how big is the threat of new businesses stealing the business that we have right now. So how strong is our brand identity? This is something that everyone talks about in the industry all the time. So brand identity, how powerful is your brand? Like, is what you are doing is powerful enough? Like, do clients know your name? That is very, very important. And 5, and the last force is the threat of substitute of products and services. So this force studies how easy it is for consumers to switch from a business product or service to that of a competitor. So how easy it is to make the same product that we have in our portfolio of products versus the competition. So do a client can just enter in our restaurant or in our company and copy what we do, or we have a very special product and cannot be copied? So this is something that we also need to examine and to really understand, like, how the competitors do it, how are their prices, what is their quality compared to ours, so how much profit they have. Do we need to lower the price to be more in the same realm? Do we need to put it a higher price because we have a more luxury product? So all the threat of substitution and the switching costs and all that, we need to take this in consideration when considering the 5th form of Porter's 5 forces. So this is a good way. For example, I put this here because this is a great way for you to start the report, like a kind of introduction type of, like, you can do a paragraph on the 5 forces and really explain everything step by step, and you can really make a good competition analysis of the competitors of this company, and really talk about where the company is and where the company can thrive or not in the future. So you can just really make a very good introduction for your paper with this, and then you can start going more depth into the strategy for the future. So going back to our 6 topics, the second topic after Porter's will be to identify the company's strategy. So look at the nature of the product, the service being offered by the firm, including the uniqueness of the product, level of profit margins. We already talked about this, and we'll talk about this again, and we will give an example. Creation of brand loyalty and control of costs. Additionally, factors such as supply chain integration, geography diversification, and industry diversification should be considered. we know that our company is diversifying from the US to India, so we should also talk about geography diversification here. So for profit margins, we can see here that we can do the gross profit margin in our example. So I took this example directly from our paper, and you can do this one, and you can see. So I did for the meal kits as an example, and you can see that the profit margin specifically for the meal kits is above 20%. According to the industry standards, above 20% is good. It's actually very good. 10% is average. 5% is considered a low profit margin. So you can do the profit margin, for example, for all of them of the products that we sell, meal kits, wines, gifts, so you can really see like where the company is in terms of profit margin and comparing to the industry. So right now we can see that in terms of industry in general, the meal kits have a very good profit margin with above 20%. So you can use this for a report saying that it's actually really, really good. So, and then we pass through the next topic, which is assess the quality of the firm's financial statements. So to review the financial statements, you need to the context. So examining the balance sheets, the issues such as recognition, valuation, classifications are key to proper valuation. The main question here should be whether this balance sheet is a complete representation of the firm's economic position. So one thing that we already know is that the complete balance sheet is in a sense a bit incomplete. This is an example that we were provided. This is an example firm, so it could be more enriched with numbers. It could have a more enriched scenario, but we need to work with what we have, right? So evaluation of the statement of cash flows helps in understanding the impact of the firm's liquidity from operations, investments, and financial activities over a period. In essence, where the funds came from and where they went and how the overall liquidity of the firm was affected. So here we really need to say, so again, we already know that in the past this company has been having negative profits, so we can see that they continue to invest and they continue to have a lot of expenses. And how is the liquidity of the firm? So we already said this in the past. Okay, so we have people that are not muted. Please mute. Okay, thank you. So we already saw this. So the company continues to invest, and we really know where the funds came from and where they went. They went to more and more expenses, but we can see that they are trying to make something new. They are trying to reinvest and they are trying to expand. So we can talk about how they are spending their funds and where they are going to spend their next and why, because they are expanding, because they are trying to make something new for the firm. So fourth topic, analyze current profitability and risk. This is something that we also did last class, and this is something that you guys already know how to do. So this is the most common analysis, such as the tools, such as the ratios and the financial ratios, liquidity, asset management, profitability, debt management, coverage and risk, market valuation. So in respect to profitability, there are two broad questions that should be asked. So how profitable are the operations of the firm related to the assets, independent of how the firm finances those assets, and how profitable is the firm from the perspective of equity shareholders, meaning that is the company paying dividends? Well, we already know that it's not, but it should. So this is something that you should also talk about in your report. Is the company is not paying dividends to their shareholders. So the goal of any company is to make profit. And if you are investing in a company, if you are an investor, you want to have profit. So this is actually a very negative scenario for any manager and any company. If you are not paying dividends, if you're not paying your shareholders, something is wrong. So it's important to really look at this in a comparative matter, and looking at the current ratios and the ones from also earlier periods, so you can compare your earlier ratios with the ones from this year. So you have information from 2021, 2022. We have the forecasting for 2023, and you can compare all these periods on all these ratios and really see where the company is and where the company is going in the future. We last class we also did a couple ratios and we did some comparisons. So this is very important for you to evaluate. So for example, here I put an example of a gross revenue growth example, where you have the revenue for this period minus revenue from last period divided by revenue by last period, and you have negative growth. And we already knew this. Yes, Karmesh, please.
Hi, Joe. I just have a question regarding the dividends part. Say, example, if a company is reinvesting its money, keep on reinvesting and not giving dividends. So is it a sign, is it a negative sign, or it still can be positive? Like, as you mentioned, not giving dividend is a generally taken as a negative part. But if the company keep on reinvesting and getting better returns in that sense, so in that scenario, how do we evaluate that company?
Yeah, so that's a great question. So what you normally see is that if you reinvest 1 year or maybe 2 to make something bigger happening in the future, I think that if the company, the managerial part of the company, talk to the shareholders and explain that, okay, we are doing this to give you more money in the future, and they all agree, I think that yes, it makes sense. But what we can see here is that from the past almost 3 years, they are in negative, meaning that maybe they are not doing the best corporate decisions, right? So I will consider as negative right now because they keep not paying to the shareholders. So something must be wrong. But I see as a clear sign for the future the fact that they say that they have a strategy, they have a vision, and they want to go somewhere, meaning that they want to expand, and with that, they want to create value. From this value, they will eventually pay to shareholders. So one thing that we also see a lot nowadays, especially for tech companies, sometimes the companies doesn't pay dividends for like years, but then they have a big boom and they can pay like very, very big dividends to their shareholders. So I think it's a similar strategy that they are doing. So it's not so ethical, I would say, to not pay to your investor for 3 years or more. But if you have a very good strategy in mind, maybe that makes sense. So what should you say in your report? What should you say is the company is not paying dividends to the shareholders. It is considered a bad sign, yes, but the company is investing in a new strategy, is expanding, and because of this expansion, the company expects to start paying back their shareholders in less than 1 or 2 years. So in the end, for the shareholders means more waiting time, but for the company as a whole, meaning that they are trying to reinvent themselves and evolving in a sense that they can then pay bigger dividends than what they would if they would pay now if they have any money. Okay, so I hope I clarify.
Can I
Thank
ask a
thank
counter
you.
question to this? Yeah.
Yes.
I mean, I understand that you're saying that they have a clear vision and that the expansion can lead to profits. But since the company is already not making any profits at the moment, is expansion the right strategy to have, or like it makes sense for the company to assess what they're doing at the moment and sort of try and look for, say, viability within what they're already doing?
Yeah, no, that's a great question. And I already had this question in some other classes. So the way that I see it is that they should first, yes, clean their own house. So before the expansion, they should first cut down on expenses, see what they are doing wrong right now, and then expand in, let's say, 1 or 2 years. But first, you need to really have a more stable income, stable net profits, to then expand, because they are doing a rushed expansion based on negative net, which if they don't do it correctly, it will completely destroy the company. So yes, I agree with you. It's much more logical first to take a step back, cut down your expenses, see what you can improve in your company, maybe sell a little bit more products, and then locally, and then when you have a positive net, then you can expand in, let's say, 1 or 2 years. So in a nutshell, replying in a very summarized way to your question, I think the expansion makes sense, but it's not the right time. So I think it makes more sense in 1 or 2 years and not this year. That is what I think.
Yeah. Thanks so much for the answer.
Yeah. Fantastic. Okay, so finishing the fourth pillar here. So yeah, as you can see, and we just talked about this, like they continue to have a negative growth. So you can see that they pass from 190, 186, then 149 for the gross income. Then this is not even the net, right? So this is the gross, and they are decreasing their revenue growth. So again, as you said, also, if they are decreasing their revenue growth, how can they be expanding with even less money, right? And you are right, and I agree. They should wait at least 1 or 2 years, put their accounts way more healthier, and then they can invest more after they are in a better position in terms of the company. So as you can see, negative growth, not a good sign. And you can do these types of calculations to really see the current profitability and risk. And here, by addressing the risk, you can see that expansion with the negative revenue growth is actually very risky, because you never know the future, and you don't know if you can actually even destroy the company because you have even less money. So the risk is very, very high. So and here we also look at the capital efficiency and solvency. So we looked at these examples last class, and we should always take these types of calculations when looking at our balance sheet. So for example, return on equity, net income divided by shareholders' equity. This represents the return investors are getting from the business. I bet this one is negative. Debt to equity. Here you can the debt is liabilities. So equity you have on your balance sheet, debt is the liability part. So the definitions of debt and equity can vary, but in general this indicates how much leverage used to operate. Leverage should not exceed what's reasonable for your business. You should also calculate this to see the leverage of your company. So liquidity, we also did this last class. So how liquid is your company at the moment? So liquidity analysis addresses your ability to generate. Please mute the ones that are not muted. Sarvesh, please. Yeah, thank you. Yeah, so current ratio, we saw this last class. This measures your ability to pay your short-term obligations from cash and other assets we actually saw that the company has enough money to pay their current obligations, so they have cash, but that doesn't mean that they are in any way profitable in the end of the year, right? So after paying all their expenses, they have money to pay their expenses, but after they pay all their expenses, they end up with nothing, right? So they pay up, they don't owe money to everybody, which is good, meaning that the bank will not take their own homes, and they will not take their own materials or impound anything. So that is a good thing. At least they have the money to pay, but they don't have enough money to then expand to the next years and all that. That's why they are also taking a loan for the expansion, because they don't have enough money to expand on themselves. So they are taking a loan to expand. But that is normally what businesses do when you want to expand like very, very fast, and to especially to a new country, you take out a loan. But this will make a lot of pressure in your short-term liabilities, because now you have a loan to pay, meaning that if now you have money to pay your liabilities, but with the extra loan, maybe you don't. And this is something that I think the company is not considering very well. So interest coverage, so earnings before interest and taxes divided by interest expense. This measure ability to pay your.
Hi, John.
Yes.
One just query. So when you say liquidity, we are only talking about interest, or basically covering the interest, right? Or the expenses. Now, what about the principal amount? So, for example, a company has taken a debt of say $1 million, and there's a principal amount, and there's also interest amount, right? The company has the capacity and ability to pay the interest, but not a principal amount.
Yes.
In that context, what do you say about liquidity?
So for the liquidity, you consider the interest, that you pay,
and not the principal money.
No, because this is short-term cash, so short-term liability.
Okay, thank you. Thanks.
Yeah, exactly. So, for example, here, and this is exactly why the interest coverage here is the interest expense. So you see the interest that you're paying, because that is normal, right? For example, look at, I bet that the majority of you has a mortgage, right? So you ask a loan for your bank to buy a house for your family or something like that, and then you pay your dues to the bank every month, and you don't have all the money that you ask for the bank. That's why you ask for the loan in the first place, right? But then you have enough money to pay your expense every month. So this is what the liquidity part of the company is. So they have the money to pay every month what they owe to the bank or to the investor. So, and this measures your ability to pay interest, a value of less than 1.5 because for concern to lenders, so bankers here. You can also calculate this and see how the company is thriving. So, and fifth one, prepare forecasted financial statements. So although often challenging, financial professionals must take reasonable assumptions for the future of the firm and determine how these assumptions will impact both the cash flows and the funding. So here you can look, for example, the break-even exercise that we have in our paper, which is something that you can clearly see in the future what is going to happen and when the break-even happens and why that happens. So you can also do a forecast in that sense, seeing from the graph that, okay, if the company sells more or if it sells less, will not break even, or it will break even in the X amount. So forecasting is always good to see all these assumptions. And the fifth and final one, so it's the value of the firm and the basis of comparison. So I've been telling this one since also the beginning with the Porter, and it's about comparing your firm with the competitors. So you should do your proper comparison, meaning that you should compare with the benchmarks in the industry. You should compare the first base for your company past is determine your financial condition. So is improving or worsening? We should always talk about that on your report. Is the company's condition improving or worsening? So typical the past 3 years of performance is sufficient, but if access to all data is available, you should use that as well. Looking at your past and present financial condition also helps you spot trends. Again, comparing, if you continue to compare, you'll spot trends like, is the company growing more, growing less, it's decreasing, is decreasing for how long, for how much. So if, for example, looking at your past and present condition also helps spot trends. If, for example, the liquidity has decreased consistently, you can make changes. The second base of is your direct competitors. So this can provide an important reality check. So having a revenue growth of 10% annually may sound good, but if the competitor is growing at 25%, it highlights underperformance. So, and this is very interesting because, so in our example, so we can actually compare this with other companies, right? In the restaurant business, like big companies, you can go wild and compare it to McDonald's, for example. You can search it online, like how fast and how much McDonald's grows every year, for example. And then you can say, okay, our company actually has a negative growth, so it's not even a basis for comparison. But imagine if the company was growing again 10%, but if the competitor is growing at 25, then it shows underperformance, meaning that the company needs to perform better and needs to go beyond what they are doing to stay in business. So lenders, investors, key customers usually require some financial benchmarks, maintaining key financial ratios and data points with preserving limited can help these third parties protect their interest. So is the company paying dividends to shareholders? Yes, no, why? We already addressed this. And then, yeah, the competition growing, all that. Yeah, thank you. I hope this was insightful for you guys. I will also share this one with you. And yeah, so please let me know. Any questions, guys.
Joe, can you suggest a very good book which can probably give us an overview of strategy, liquidity, solvency, something which will be used, for lifetime? Any books that you can suggest?
Yeah, I will send via email.
Right.
Joe, from the assignment perspective, generally we have some templates or some docs provided by the university till the previous assignment. But the current assignment, it is very open, so it is quite challenging to understand if we miss some key elements. So if you could just guide us on that, that would be a great help.
Yeah, no, absolutely, and I agree with you. I also think that this assignment is very open, and it really gives a lot of base for discussion, and that can be good and bad, right? So depreciation, so that can be good and bad, meaning that so one thing that the university keeps telling me is that they want to see how your base for discussion and base for strategy is. So because you are in MBA, you are being trained to be managers, you need to have strategic thinking. You need to know how to make decisions, and this is the first thing and the most important thing. So first part, of course, make your calculations. After your calculations, what you take from your calculations, and this is your own perspective, what you see in the market. Again, you see a billion companies. There is no right or wrong. Sometimes you think that something is very right, and then it ends up being the right thing or the wrong thing. So of course you need basis for comparison. So you have a lot of basis. You have the ratios. You know how the ratios work. You know what the ratios mean. So you take that and you explain what do you want to see as your strategy for expansion. For example, the question that the student asked like 10 minutes ago about the expansion being now or being delayed. I completely agree about being delayed, and I also talked about that last class. So if your company is not profiting right now, do you think that it's a good way to ask for a loan in the bank to expand? No, that is absurd, right? First, like, what kind of bank will give you a loan for you to expand if you have like no money right now? Of course, that you have money to pay now, and we saw that with the current ratio. So that's what the bank saw. The bank saw, okay, these guys have enough money for their short-term liabilities, so we are going to give them money because we know that they will pay. But for the expansion, they have no money. So that will be actually a wrong strategy. So you should wait at least 1 or 2 years. Again, gain back the trust of your shareholders, because the shareholders are the backbone of the company. You know, they are the ones putting in the money. They are the one trusting in the managers and in staff. So if you don't create confidence on your shareholders, eventually they can stop. They can just stop putting money in. They can just bail, and then the company is out. You know, so yeah. So again, it's a lot about like, how do you envision the company in the future? How do you envision the strategy, and how do you envision like what really makes sense for the expansion? You know.
Yeah, but John, on the contrary, what we see the startups in India, and there are some big firms like Zomato or a lot of companies have just come up in these 5-6 years, right? Swiggy and so many others. What we see that if you look at the P&L is actually negative, but then there's a lot of money that is coming as a foreign investment, or maybe some companies investing in that, and they go for expansion.
Yeah.
Can you just comment something on that? And those are very lucrative.
Yeah, no, absolutely.
Those are very lucrative. Yeah.
Absolutely. So you are in my realm of expertise now. I work a lot with startups, so this is a great one. So yeah. So the thing about the startups is that, so you have a new product, a new technology, or something that is very new and people are very excited. For example, you saw that with WeWork or even Uber, and why the shareholders and the investors keep putting on money, because they know that they will become a unicorn or something, and they will make the multiples. So you have like the 10x, the 100x, 1000x. So they will give back the profit 100 times, 200 times, 300 times. So they know that it's just a matter of time for these companies to blow up. And the example that you are using is exactly the same thing. So it's a new product made by a young team. Again, teaming startups is crucial. It's very, very important. Actually, we have no information about the team on our report, and I would like to have, because that will make a huge difference to know who is the people that are actually managing this. Is this managed by 80-year-old men that are washed out and they don't know anything else, or these are young people with like on their 30s that with really good resume, good universities, and like really good backgrounds? Because I would put more money if I see growth perspectives, versus some old people that they are not going to be here for the expansion, So this always makes a lot of difference. And unfortunately, we have no information about the team of this company here in the report. So we cannot comment on that, but that is a great way to comment. If the company has the right team, if the company has the right backbone, then I understand why the shareholders keep putting more money, because that's the startup scenario. And you are absolutely right, So in startups, you see that investors put in money sometimes 6 years, 7 years without any return, and then on the 8th year they get so much money that they cover for all the 8 years, and that happens. So yeah, so if you want to take a more startup approach to this, you can, but I don't know if this company is a startup or if it looks like a normal startup. So yeah, you can say that, and that is fine if you want to say that, okay, this could be a startup, and I want to take it as a startup. But by the way, you actually have in the beginning of the report here something about they are already public. and they are already public, meaning that they cannot be a startup if they are already public and if they they have a stock, a public stock already traded and all that. So one thing that they can actually do is become private again. You see that with Elon Musk. Companies like Elon Musk does this all the time. So he puts the companies public, then they buy back the stock, then put the company private again, and with that he can do all these strategies and gain control. But this, because it's a public company and has public shares, the dividends go to the public shareholders. We can be thousands and thousands of shareholders right now because it's a public company. So it's a different scenario. I understand your question and I agree if this was a startup, but it doesn't look like a startup to me, unfortunately.
Joel, hi. So this is Sarvesh. Sorry, I might have a lot of background disturbance and my apologies for that. So in the query is probably just example of this company shape tag, right? While you quoted one thing that probably these companies are already into losses, so it does not make any sense for them to right now look for a higher loan and go for expansion in different market. Rather than that, they must try everything to do so that they can become profitable in next coming year, probably couple of year or two or something, whatever. Then they could think about expansion. That's one line of thinking. Other line of thinking, if you also look at that, the market is shrinking in US, the profit margins were shrinking, they're facing tough competition from other players in that market. And also their share price, if you look at, which was, I mean, when they got listed, it was very high, but eventually that has declined drastically. Somehow, somewhere that shows that probably that's not the right market for them now. And now only way to become profitable or get, to remain solvent, they need to take more money and then expand in new markets so that they can again become profitable. Don't you think that could be a way to look at the entire proposition here right now?
Yes. No, I agree that they need to expand. And I also said that I agree that they need to expand. I'm just saying that maybe they can wait 1 year or two and first take out clean their expenses, like they have a lot of expenses, and turn into a positive net profit, and then expanding, let's say 1 or 2 years. But a quick expansion can be good in this market too. So yeah, first clean the balance sheet. Exactly. That's it. I agree with that.
Yeah. Okay. I get that now. There. Thanks.
Yeah. Like they will eventually need to expand. That's clear, so they already have the market now. They already did everything they wanted to do. They need to expand. The question is when, and do a quick rushed expansion. Maybe it's not the answer. Like you can expand in 1 year instead of now, yeah, that's my thinking. Yes, next please.
So Joao, Aditya here. So if you look at the prospectus, so they have given us what they call the Porter's generic strategy, right?
Mm-hmm.
Which is it has been pitched scope versus the competitive advantage. And this particular company, at some point of time, initially it was focusing on cost leadership, but then they chose to come into maybe the quadrant of differentiation, right? And
right.
Why they did this is because they somehow felt that that they could not keep up with the cost. So from being centralized, they went to decentralized. When they went to decentralized, more warehouses, more wages, because I think more workforce being deployed on ground, more machinery in terms of those coolers or freezers being deployed everywhere. So actually, maybe what possibly is required is a major restructuring.
Yeah.
And I was just thinking, why the Porter's generic strategy, this particular diagram, right? Why has this been given? Can you comment on this diagram, please? It's there in the prospectus.
Yeah. This, so you can use this one, but this one is not, it's not very clear, you know. So yeah, it's not clear, so don't use it. don't use this one,
because I mean, yeah, you're absolutely right. So I mean, we've also been trying to make sense out of this diagram, you know, because it's been given as part of strategy and implementation.
So if you want a good one, use Porter's or use SWOT. I'm going to put this here. So if you look at SWOT analysis, please look at this. If you want, SWOT analysis is the most common one. This is in every business plan of every company. So the Porter is more about the analysis, like in-depth analysis. You look at the competition, you look at the suppliers, you look at the pricing. So it's more detailed. SWOT analysis is what startups use, what companies use. So please use this one, like disregard this one. Don't use this at all. No, this is not good.
Okay, thanks.
No, yeah.
Yeah, but also I look at this way, and the other way to look at this thing, that they're prospectus, and it's absolutely not clear. In fact, it clearly shows that probably it's very confusing, right? So probably that is another say indication that why this company shouldn't look at expansion. Rather, they should try to clean the balance sheet at this stage and have clarity in what kind of market, what kind of leadership they want to adopt to.
Yeah, agreed.
Yeah.
Agreed 100%. Yeah, they first should look at their present and they clean what they are doing, and then they move on to the next stage. Absolutely. And then that will also create more motivation inside the company, because imagine if you are an employee in a company that is not profiting, is not making good advancements, you also you feel sad. If you are a manager or a CEO and you see that your company is not profiting for years and years, maybe you're not doing your job right. So that, like, by cleaning your balance sheet right now, we also raise motivation, and that is so important nowadays for firms, like team building and motivation, and make sure that everyone's on the same page to take this company to the next stage. So yeah.
Hey Joe, Ashik here.
Yeah.
In the share pricing, in the prospectus page number 5, there is an S mentioned in the graph. Does it show a split share? That's it.
Wait, let me find it. Page 5. Yes. Which one?
The graph. It shows an S mentioned somewhere. So does it mention? Does it reflect of a splitting of shares that side?
Yeah, I see the S here, but they don't talk about anything, and the pricing stays more or less constantly dropping.
Yeah.
So I would say to ignore it. Don't.
But usually when we see S, it looks like a split share, and D is a dividend. So that is where I was just thinking on that part. So, but the graph does not show anything of that stuff.
No, it doesn't show anything crazy. You actually have, so let me maybe show you this. Let me share my screen and show you this. Actually, there's some small details, but it's so small that I don't think you should lose a lot of time with this. So if you see after the S, you have here, very, almost you cannot notice it. You have a green line going up. This is the volume of shares.
True.
So this line here, by the way, people that are not really used to read the stock graphs, this one is the volume. So means that how much trading is happening at this period. So, and you see this S, you see here a spike on green, meaning that there was a lot of people buying up in this specific period of time. Here you see a lot of volume. In the end, also a lot of people buying, a lot of people selling at the same time, but the value stays more or less constant, but there is a lot of trading, like going up, down, and then the value stays. You also see this, so you have a big spike on volume on green, and then it's so big, and then you have no red on the side, that the stock goes up. here because you have a big line of volume, meaning that a lot of people entered in the market and bought at this specific date. And this is 2020 first quarter, more or less. Let's see if in the balance sheet they have something like 2020. Yeah, but we don't have the 2019 to compare. Yeah, we have here actually to compare, but there is nothing major happening. It's just on the equity part, and yeah, we don't see any crazy movement here. So I will say for like to avoid any extreme complications or like I think you can just ignore this because like I don't think they want you to analyze the stock graph. You can do a general analysis on the stock saying that you see spikes of volume trading in specific points, and then you can see a split, but like it's not mandatory for the report analyze the stock, so you don't need to lose a lot of time with that.
Right. And one more question is, since there are a lot of startups and you're there in this domain, till when do we call it a startup in case it is not listed? What is the tenure that we look into calling it a startup? Because I understand there are already so many companies that have not been listed, but they are there present for say 30 odd years or 40 odd years. But so what is the domain that, general nomenclature, till when do we call it a startup?
Yeah, so that is a great question, and I think nowadays that is all over the place, right? So you have a million startups and everyone is a startup, and maybe even upGrad is a startup. I don't even know.
Why I ask this question is that, there are many incentive schemes that are launched by the government for the startups. So, till what time can you apply for those schemes in case, you are still called a startup, or maybe a 20 years company is also called a startup. So what do we look into that part? So usually
so that is a different question. Okay, that is a different question. So normally these incentives, they look at the team, meaning that the how big is the team. For example, if you are a company with like 100 employees, you are not a startup. If you are a company with like 50 employees, maybe you are not a startup. If you are a company with 5 employees and you are running for 30 years, not a startup. If you are a company with 5 employees, maybe running for 10 years, I will say that you are in a limit. I think 10 years is like super limit. But what the banks and all these lenders, they look when they do these competitions is normally the team age and the team itself. Like, for example, if you have a board of a company with 5 people and everyone is 50 or 60 years old, they will not consider the startup. Probably. They want to see like young people, like 20s, like fresh out of college with like maybe not so much experience or enough experience to create a company in like with 1 or 2 good advisors on the board. Then it's a startup. It's a new product, probably technology or something like that. And so it's more, I would say the startup thing is more about the team and and the size, team and the size. That is very important, and not only the time factor. But yeah, I already seen startups with like 5-6 years and they are still considered a startup, so it depends on that. And also Shark Tank, exactly. Like, in Shark Tank you see so many examples like that. Like, you see companies that are running for like 5 years or 6, they are still startups. Why? Because they have a small team, they are probably not profiting much, or they are profiting, let's say, 1 or 2 million a year maximum, and that is not a company. You cannot buy a building with 1 million, you can buy a house. In this market, you can buy a room with 1 million. So those are normally the factors. Like,
so say for example, a unicorn company who's become a unicorn in say 5 or 6 years. So they would not be called a startup, is it?
After you become a unicorn, you are definitely not a startup because you are surpassing the $1 billion mark of growth. So you are definitely not a startup. You are a growth company already. Yeah.
Joe, Aditya here. So as part of the analysis and giving a solution, so somewhere, the solvency of the company, and in case a company is going insolvent. So there is something about regulations, right, which we have to take care about. Of course, we would have to look at regulations in the domain of India, right? Like we have the Company Act, or something called the Company Act of 2013. But speaking generically, right? Would you like to tell us something about the legal aspects of insolvency? Someone who's heading towards bankruptcy.
No, absolutely. So if the company is heading to bankruptcy, you have several types of laws. So you have specifically two laws in the US. You have two bankruptcy laws. This Chapter 11 and Chapter 13, if I'm not mistaken. And one of them is that your company, when it goes bankrupt, you have to liquidate all the assets, but you are not specifically entitled personally for that, because it's a company. The other one, you can also go down with the company and say that you personally, as a shareholder, you are bankrupt and you can file for that. And with that, then you have all this process of really seeing what do you owe the company, what you don't owe, what the shareholders need to pay back to the company or not. So in a nutshell, what you need to do is, if the company goes bankrupt, do the shareholders are liable, yes or no? We don't know, because we don't have that information. So we don't know if this is registered under another company or an umbrella company, which happens a lot nowadays, or if it is registered under the shareholder's name, for example. If in that case, a person will be personally responsible, yes. In the other case, it will be a group of people or another company responsible if it's under an umbrella type of organization. So what you can say about bankruptcy is that if the company goes bankrupt, then the shareholders will be compliant and will be liable, being the shareholders another company or the persons themselves. And then they will need to file in for the best lawyers and filing for the best laws for their own case, and try to make the best case as possible for themselves and for the employees also. That's what I would say.
Thank you. And Joe, I have a request. When you share, the Excel sheet and the presentation with us, you had shown us a sheet on the break-even point last time.
Yes. Yeah, I will share. Yeah.
Can you please add that also? Yeah.
Absolutely. No, I will send you, of course. So I have a question here. Why Australian tax for a company that is in the US and expanding to India? I have no idea why they asked that. So let's look at that. And they have it here specifically. You also factor for Australia's sales tax, this tax, blah blah blah. So probably this probably has to do with something of the manufacturing of the product, or they probably do something in Australia. We don't understand why or what, but they probably have something in Australia, even if it's the supplier side. Maybe they get their foods or their products in Australia, and yeah. So, but if they said you have to account for it, maybe it's a supplier thing, and you need to account for it, and that's it. Okay, is depreciation including fixed cost BP?
Yeah.
Let me see.
Joe, I have a question. Can I come in?
Yes.
Yeah, my question was about, since I think Aditya was also mentioning about that the organization is struck up between cost strategy and between cost and differentiation. So my question was, since we need to increase the revenue, how do we evaluate the product price per unit pricing strategy? How should it be evaluated? Can you please guide?
Sorry, can you repeat?
My question was about how can we evaluate the product price? Can you guide how should we compare it with some industry standard or something?
Okay, yeah. So when comparing product price, you can compare with other products in the industry. You are telling specifically for the industry comparison or a specific one?
See, we need to enhance the revenue partner. So how should we, think over, can we increase the price of the product per unit price? Or how should we, decide upon this part?
Okay. Yeah, someone is here telling you that you can compare with HelloFresh. They also say that it's in the report. So you can use that as base.
Okay, that can be done. But HelloFresh, the strategy is different. Now they are low cost provider.
Yes, so Dheeraj, I would like to come in. Joe, this is actually the point which I was trying to bring out. The strategy which is mentioned in the document, it says that this company shifted from cost leadership to differentiation because they could not cope up with the the cost leadership which was being offered by the others. So their planning is we come into a more niche category, we differentiate ourselves by giving a fresher product for which he got more warehouses. He goes close to the farmers or the fresh providers, so he gives a fresher product. But somehow this differentiation strategy doesn't seem to be working, because what's happening is, if you recall, last time we had seen the break-even point. I mean, we couldn't achieve the break-even point. The two graphs, you recall. I mean, there was no way we were finding that we could have a break-even point.
Yeah. No, exactly. And so what you can compare is, since that we are in a more niche market like small market type of thing, you can compare it with the local markets, and you can actually do that even in your own hometown. You can go to the supermarket and compare the prices. For example, for the one product that I think that you can compare is the wines, right? So how a simple bottle of wine, how much it costs, and if that is correlated with the unit price that you have, and if it's a higher or not so high product, what is the price differentiation compared to other fresh products that you can find, not only in other companies but in your local area too, because they are expanding to India. So you can clearly say, in India we have this price, and you can take a picture and put it in your report, say, hey, I did my homework. In India, I have this price for wines, for a normal wine, for a table wine. And if they have this and they want to expand to India, this is the price that they should expect for the competition. So you can definitely do that. It's a real example in the real marketplace that they say that they want to expand. So it's a real comparison, and you can definitely do that. It's a real comparison.
Sure. Thank you.
That's a good point. Thank you so much.
Yeah, absolutely.
Hey, Joe, I have a question regarding that is not regarding to the assignment. It is a very general question.
Okay.
What happens when you have got your returns or your payback? I won't say payback, but you are starting the revenue generation after 10 years. I'll just give you an example. Some of the companies which are investing in, say, example, in East Africa on the offshore gas field, like Exxon was there in Mozambique and Tanzania. Total was there, Exxon, Statoil, they both were there in deep water gas in Mozambique offshore. Now they did the discovery somewhere in 2006 to 2010. And they're about to start the gas production somewhere between 2026, 2027, somewhere after 15 or 16 years. Now, and that is where once they start the production and when they ship the LNG, then only the revenue will start. So their payback will be another 5 years or 3 years down the line. And they've already invested around $15 to $20 billion. In that case, or in that scenario, considering those, how do you compare what are the standards? Generally, when we do the financial modeling or we understand the financial modeling, we say that the payback is more than 10 years. The project is not feasible or viable. But in this case, when it is like it is 15, 20 years or 25 years, in those conditions, how the project is viable from accounting, not from any other perspective, just from the accounting or financial part.
that is, so you are talking about future cash flows. It's completely
Yes.
different from the subject that we are looking at. So I will give you here. So you should look at the IRR, so internal rate of return of the project. So normally for gas projects and infrastructure project, your IRR should be at least 11% throughout the 10-year cycle. So if you don't find this type of measures in your cash flow analysis, probably that's bad. So you should have at least 11% IRR for infrastructure projects like this size that you are saying. This is the industry standard, is about 11, 12, 13%. And you should do a very, very intense cash flow analysis with DCF. So I also will leave it here for you to search DCF, discounted cash flows. You should have a very good discounted cash flow for your future cash flows. And another thing that is, it really depends on the investor type, meaning that some investors do like projects that are return after 15 years. 20, I found it hard to believe. It's very rare to have investors that go for 20, but like 15, some go for 15. But normally what I see in these types of projects is 10 years. 10-year payback period is what normally we'll look at when looking at like gas projects, like solar, hydro, even oil is like 10, 11, something like that. And then you have like really big profits. So yeah, very, very quickly, that's what I can tell you.
Understood. So it just the
but drop me a message on LinkedIn. We can talk more about it.
Sure, I will just drop you. I will connect to you. So actually, I'm yet to start the project part, the assignment part. I was on vacation, so I couldn't complete
no
all
worries,
part.
No,
So I will start right now. So I'm just
I work also with gas investments, so it will be great to talk.
Okay, sure. Thank you.
Okay, fantastic. Guys, so we are already over time. Yes, so
Hi, Joe. Just one question, Tripti here. So my question is, depreciation being a non-cash item, do we include in the fixed cost? Because basically, like if we look, the machines are depreciating, like the value of the machine is depreciating year on year, but actually the cash is not flowing out, right? So how do we, why do we include in the fixed cost? Because it's also given in the assignment, like the percentage increase of depreciation is given in the fixed cost. And also in our modules, in the example of PVR, the depreciation was also included in the fixed cost. So can you explain that, please?
So yeah, that's what I said. It's a fixed cost. It's included in the fixed cost.
Yeah, like I'm just asking the reason. Like it's a non-cash expense, right? So basically, the cash is not flowing out. So why are we including in our it in our break-even analysis? The cash is not flowing out, basically, right? So why do we include that in the cost aspect of our product?
Because there is the cost to maintain the machines also. There is the cost of maintaining the machines.
Okay, so so we need to include the depreciation, right?
Yes.
Okay, that's it from my side. Thank you.
Yeah, exactly. Okay, so let me do the Google Drive for you guys very quickly, and then I will drop you the link. Just give me one second. Okay, Google Drive. Just doing a quick folder, and I will put everything there. Okay, MBA. Okay, MBA. Okay, I will send you right now. See.
Sorry to interrupt, Joe. One more question. Like in the 7.4 of our prospectus, it is given that the wages, where the variable cost is given for the year 2023, it is given that there's a note that is given, just a second. The note that is given is yeah, the direct labor variable cost above are included in salaries and wages value in the profit and loss report. This should be considered in calculating the break-even analysis. So what do we exactly have to do about it? Like, do we need to include it, or maybe then subtract it from the fixed cost part and add in the variable cost part? Like, what do we have to do exactly for this?
Yes. Okay. Let me just share the link. I will reply to you very quickly. Let me just give the link to everyone.
Sure.
Okay. Yeah, I think it's already public. Can you check? I still didn't put anything there, but the folder is already there. So it is?
Yeah.
Yes. Okay. Fantastic. Okay. So replying to your question very fast. Yeah. So the direct labor is already included in salaries and wages, meaning that for this specific break even, you don't need to account for that 15K. We talked about that in the last session too. The other one, so the direct distribution, they're all variable costs. The salaries and wages, fixed cost.
Okay, so we don't need to include that again, just that, right?
No,
Okay.
exactly. It's already included. Exactly.
Okay, Joe. Thank you so much.
Yeah. Okay. Yes, guys. I will put, as soon as I close, I will put everything there. Don't worry. And if don't worry, guys, I will put everything there. I will put everything. So I'll just just you need to do the polls, because they asked me to. LinkedIn will be inside my folder. So I will put the presentations there, and there will be my LinkedIn link, so you can have that in the folder. So in the presentation and in the folder. So thank you very much, guys. Thank you, guys.
Thank you, Joe. See you then.
Thank you.